Hello, everyone. Happy Friday. It's December 2nd. We're going to wrap this week by focusing on how the markets have evolved over the last 5 trading days. Choppy session, lower open, rallying back about a net zero for the day. We'll look at all those charts and more. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the language of technical analysis. The StockCharts platform is designed to provide you with the tools, education, and commentary you need to make sense of these markets. I've had a lot of interviews through the course of this week and last, had a lot of conversations about the overall market environment, talking about the sort of push and pull between the seasonal strength in December, the seasonal weakness that often happens in the new year, particularly in the month of January, coming out of a midterm election year. Having said that, those are all just sort of tendencies, right? What is the price? What are the markets actually telling us back? We're going to dig into those stories and those themes as much as we can on our show today as we wrap this week. Wanted to let you know about the upcoming schedule. We had a couple of really interesting discussions. Javed Mirza with some great long-term charts about markets, different asset allocation takes. We had Julius DeKempener yesterday, really interesting discussion about a rotation to more cyclical defensive type of sectors. Next week, 3 good guests as well. On Tuesday the 6th, we have John Kosar of Asbury Research in Chicago. On Wednesday, Leslie Juflas from here in town in the Seattle area. And then on Thursday, Frank Capilleri from his own firm, actually, that he just recently, I think, called CapTech, and I should know that, and I apologize, Frank. I'll clear that up for next week. But Frank it was a long time at Instanet and a really thoughtful, knowledgeable technical analyst. Should be fun talking to him as well. Let us continue on our show today with our Wrap the Week segment. Friday, we like to wrap the week. We like to answer questions from our mailbag. Before we do those, let's answer a recent poll question. We always have a poll running on our live stream page at StockCharts.com, also on our social media accounts. So make sure you follow us on Twitter at StockCharts and at FinalBarSCTV, and of course on our YouTube channel. We asked you recently, where do you see the S&P 500 index 1 month from today? Within 10% of current levels, 70% of you answered that one. 20% of you said at least 10% higher. Only 10% of you said at least 10% lower. It's a really interesting question and a really interesting reaction. So let's take a look here really quick. I'm going to add a little bit of extra time on my S&P chart here. I'm going to use the annotation engine and say, all right, take where we closed today here around 40.70. Let me go 10% up. That puts us around, 44.70, we'll call it, which would take us past the August high and go up to really where we were in April. If we go 10% below today's close, that would take us down here, which is, for all intents and purposes, retesting the lows from June, right? Basically going back to the low in June, that'd be around 36.50, 36.60. Wouldn't quite get to the low, the intraday low, around 3,500 in October, but would, for all intents and purposes, be retesting that sort of area. You know what this looks like if we would get a 10% drop would be a big head and shoulders bottoming pattern, what's actually called a Buddha bottom, although you probably don't need to know that. But basically what this means is a downtrend, lower lows, and all of a sudden this third one is a higher low. If that would happen, boy, talk about a compelling buy signal, right? A higher low on the longer term time frame like that. But what's interesting to me is that 70% of you said over in the next 1 month, we basically end in this area. And I would certainly vote that for sure. And I will tell you, because if you're bulled up because of this rally off of the October lows, I would be concerned about how much further we really have, right? What are the possibilities we actually propel above the August high? Are things really that good going into the new year that we feel like we would start the new year well above 4,300? I'm not sure if I see that. On the other hand, what are the chances, given the strength off of the lows, that we completely buck the seasonal tendencies? We have a horrible December and we drop another 10%. I would say that's equally as unlikely. So I think sort of ending the year somewhere in this range is probably a reasonable assumption. And that doesn't mean we can't be super choppy and annoyingly sideways during that period. Great poll and great answers there. Thank you guys so much for responding and making that an interesting discussion we can have. As we wrap the week, the second thing we like to do is check what I call the wrap the week chart. This is basically looking at how the returns played out through the course of this week. We'll check in on today's trading here in a moment, but through the course of this week, you basically had the dollar lower and everything else higher. So the average week in 2022 has kind of been this entire thing flipped over, right? Stronger dollar, weaker everything else. That's why we called the dollar the wrecking ball for risk assets. Because the dollar is so strong, it means commodities, stocks, bonds have difficulty materializing any sort of meaningful gains. This rally off of the low in mid-October, this pullback in the US dollar has really changed the character of this market in the last 4 to 6 weeks. And this week, just a microcosm of what has happened on a larger basis over the last 4 to 6 weeks. So the dollar ETF, the UUP, was down just about 2% this week. Everything else was positive here. And actually, hold on a second, because I'm noticing we didn't have that 50. I was going to say this didn't look 100% normal to me. There we go. I was going to say this looks a little bit more like what I remember. So here's last Friday, the 25th, kind of have a weird holiday week last week. Then we're looking at the next 5 trading days. So here's the same story, though. Just the numbers are a little more correct here. So here have the dollar ETF down 1.2%, right? And that's from last Friday to this Friday. The S&P 500 up 1.1%. Everything else outperformed large cap U.S. stocks over the last 5 trading days. We had in purple the small cap index IWM is a Russell 2000 ETF, up 1.3%. In pink, we have the NASDAQ 100 up 2%. In gold, this is gold, the GLD ETF, which is up 2.5%. Bitcoin up 3.2%. Bonds and crude oil about the same here, although bonds sort of a more nice push to the upside over the last couple of days, both ending the week around 4.3%. And emerging markets, EM, with a rare win for the week, up 4.7%. Now, obviously, the dollar strength has been one of the toughest parts of 2022. That's why it's been so difficult for things like gold and equities, to be honest, bonds and others to do well because the dollar was so strong. Now we're getting a bit of a mean reversion from what we've seen for most of the trends in 2022. Today, not much of a change at the end of the day for the major equity averages. The S&P, NASDAQ, Dow, all finishing the day within 0.2% of where we started from thinking of yesterday's close. Now, all of those gapped down at the open and then pushed higher through the course of the day. So you had an initial sell-off there coming into the open, but then through the course of the trading day, sort of a nice, slow and steady gain. So no real gain to the upside, choppy, but no directional change from yesterday. Where there is directional movement is the VIX, which continues to push lower. The VIX is well below 20 now, almost to 19. Interest rates pushing lower through the course of the day, but that's after gapping higher. So bonds actually gapped lower and rallied higher through the course of the day. So just like yesterday, you have a very similar contour from Thursday session to Friday session with interest rates going higher earlier in the day with the 10-year yield pushing to around 363, finishing the day just above 3.5%. The dollar index, as I mentioned, coming off through the course of the week, down a little bit from yesterday's close. Mixed signals here overall in commodities, although energy prices were weaker, oil prices were down, and the energy sector struggled a little bit today. Bitcoin, Ethereum, both positive, but not by much. Relatively quiet day, to be honest with you, all around. Besides the move in the VIX and the pullback in the dollar through the course of the week, overall, today was sort of a quiet session, I would say, for all intents and purposes. Now, having said that, there are plenty of individual names having some decent moves. First Solar, Enphase are sort of some of the top-ranked stocks in our large cap universe. We'll hit on a couple just quick charts here, and they get to our Mindful Investor Live chart. Scooter using the large cap Scooter rankings. Enphase Energy, which is in the renewable energy equipment space, one of the top-ranked names. That's actually in the top percent of large cap stocks, making a new 52-week high today, up 7%. But the one-day rally of 7% is not what excites me about this chart. It's the fact that the 7% rally takes it to a new 52-week high and completes this consolidation phase, right? So if you look at the chart of Enphase, you had this gap in late July, another gap the day after, pushing us up here to the low 300s. From there, we've sort of been sideways, right? Sort of revolving around that 300 level. And you can see in August, September, October, November, sort of all revolving around that level. Bit of a dip here, and we have what's called a head and shoulders continuation pattern. It's sort of unusual, but certainly has happened. And you can see it here. We have a rally, then you have a low, a lower low, and a higher low, and then a fairly consistent resistance level around 320. We broke above that today and completed this week in a position of strength, the relative strength appearing to make a new multi-year high. All of that is pretty strong. And again, it's not just today's strength that is attractive. It's the strength that builds on the previous strength we've seen over the last 6 to 8 weeks. Nice chart and a nice breakout resolution to the upside. Quickly on sectors, materials, industrials, consumer staples at the top of the list here. Reminds me of my conversation yesterday with Julius DeKempener talking about the strength in some of those cyclical sectors and some defensive sectors like consumer staples. That's what the RRG analysis would point us to. And today, for what it's worth, that's where the leadership was. Materials up 1.1%, industrials and consumer staples both up about 0.5%. The laggards list, you had some defense like utilities, real estate, and then also energy and technology, all down about 0.5% or a little bit more. To finish off our weekly wrap segment here, let's look at the Mindful Investor Live chart list. This is a list of charts that I keep updated on the StockCharts platform, always trying to keep these updated with what I'm seeing and hearing. You can access this from my blog, which is called The Mindful Investor. Just click on our articles page at the top of the website to get to my blog. We start with the market trend model. No change this week. The medium-term and short-term models have been bullish for the last 3 weeks. The short-term model has actually been bullish since mid-October. The medium-term model turned bullish just the beginning of last month in November. Long-term model still negative. And when I look at the chart of the S&P 500, short-term and medium-term both, I think, legitimately strong. The long-term still negative. And again, we've not quite done enough from a technical perspective on the longer-term time frame, in my opinion, to label this anything other than a bear market rally that's rallying into resistance. And I know that at times is an unpopular opinion. I've had pushback on social media and elsewhere for calling it a bear market rally. And again, that's not a judgment. That's more looking at the evidence, right? The fact that we've seen this sort of channel, this downtrend channel in 2022. That downtrend channel is broken when we break above that trend line to the upside, and we're right there. But we haven't done it yet. I think that's a question that would most likely be answered in the next week or two, right? And on the daily chart, you can see this trend line that I'm talking about. I posted a YouTube video just yesterday. My channel is called Market Misbehavior, and I called it the one trend line to rule them all. And it focuses on this green dashed line here. Connect the highs from January, from March, August. All three of those highs line up pretty well, and that lines up almost perfectly with this week's high from Thursday's session. Today, we sort of traded below the 200-day, closed back above it, and now we're testing this trend line as we go into next week. So one of two things happens here, right? Either we get above this trend line, we get above 4,100 in the next couple of weeks. That would really play pretty well with the traditional seasonal strength that you usually see in December. That would indicate, in my opinion, a likely acceleration to the upside up to around 4,300, 4,325. That would take us to a Fibonacci level. That would take us to the August high. I think that's a reasonable upside objective if we see further strength beyond what we've seen so far. We'd also need to hold the 200-day moving average. And the other option is we stall out here. And part of what I talk about in that YouTube video is equating the current market to what's called a power on stall, which is an aviation term where basically you have the wrong angle and the wings can't produce lift anymore and the nose dips down very quickly. That is a potential outcome here. Check out that YouTube video to get more details on the beautiful metaphor I just outlined for you. A couple other quick things just to finish off, and then we need to move on here. In terms of breadth, the only, the final chart I would share with you is just the breadth conditions have been fairly strong, right? Not excessively strong, not strong to the point where I think it's a concern. But when you look, over half of the S&P members are above their 200-day moving average. I see that as a positive. 90% of the S&P members are above their 50-day. I see that as a positive as well. Now, you can say that back in August, when we tested the 200-day moving average, we had a similar value here, and that's true. But overall, that's usually a sign of strength. That means most stocks are actually doing pretty well. And I think overall, if you look at a bull market phase, that's how they tend to begin. The question is it sustainable? And that's when we need to hold the 200-day, some of the other things, the trendline resistance and other things that I mentioned earlier. Let's take a quick commercial break. We'll be back powering up your use of the StockCharts platform. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close. It's such a pleasure to put this show on for you. We have a lot of exciting plans for the Final Bar in the new year. We're going to take the last 2 weeks of the year off with most of our live programming on StockCharts TV as we finish our new studio. Enjoy the holiday season. We'll be back live in the new year. We've got a lot of good content before that point. A couple other announcements before we continue on the show. First off, we welcome your questions. We're going to do a mailbag here in a couple minutes. All these questions come from viewers like you in the last couple days, so keep the great questions coming. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air next week on Tuesday's show. Also, go to StockChartsTV.com. There's so much fantastic content that we post there. A couple hours every trading day of new ideas, new perspective, and new observations on the changing and volatile market environment. All of that content is available for free at StockChartsTV.com. Or on your mobile device, just search for StockCharts TV on demand. Let's continue on our show today with the Power Up segment. What we like to do on Friday is sort of upgrade your use of the StockCharts platform, show you some of the tips and tricks that we've learned and myself and others have learned in years of using the StockCharts platform. Today, I want to talk to you about the annotations capabilities on StockCharts, just a couple of them. There's so many things we could talk about, but I usually use Sharp Charts and ACP with a lot of my own investing and doing short-term things. I look at the StockCharts ACP platform. I'm actually working on one of the new suggested layouts that we're gonna post to the ACP system here very soon. But in the regular Sharp Charts, which are sort of the traditional charts on StockCharts, just below the chart, you have this button called Annotate. And if you click on that, I'm going to highlight 3 things that I use every day, which I think really make the platform sing very, very well. First off, I'm always highlighting support and resistance levels. I'm looking at a chart like Apple, and I want to highlight the fact that 175 is potential resistance, 130 is potential support. Here's the way that I do that. Click on Trendline on the left, and if you click on $175 or so with your mouse and drag to the right, you have this issue where you're trying to get a vertical line. It's super easy. You just hit the Command button if you're using a Mac keyboard. On a PC, there's a way you can do it. I forget what it is, but I'll show you how you can find that out. But if you move your mouse to the left, it assumes you want a vertical line. If you move your mouse to the right, it assumes a horizontal line. This is a great way to make it perfectly horizontal, not kind of or hopefully horizontal, but perfectly horizontal. So when you see these beautiful horizontal lines that I put, that's because I'm holding down the Command key on the Mac laptop or Mac computer and then dragging the mouse to the right. It makes it perfectly horizontal. I'll show you in a minute how you can find that out on your own computer. I also often do a thing called shaded areas, and this is a trick that Arthur Hill showed me years ago. If you click on the rectangle object, sort of highlight an area. Let's say I don't want to do a line, but I want to highlight more of a range, right? Some particular range that I think is important. Make a little shaded area like this. It's an opaque color. And then you click here on the little color thing, and you can take this down a little bit, make it a little more transparent. And look how this makes this beautiful little shaded area. You know, many, many years ago when stocks traded on 8ths or 16ths, you could have a perfectly horizontal line. And just because there were only, 8 increments, 12.5 cents a piece that stocks would trade between dollars, the chances of you hitting a line precisely were very, very high. Now that we're trading at sub-penny levels, that's pretty unrealistic. So I often like to illustrate things not as just a line, but as a range. And that shaded area is the way you do it. Make a rectangle, make it a little more transparent, and it can show you there. The final one very quickly are the parabolas. And if you click on, where is it? Under trend line, go to parabola. If I want to highlight some like head and shoulders patterns or something, I like to do the parabola tool like this. You free draw it, and then it'll lock it into an optimized parabola. You can click on this middle thing to change the angle or change the shape of them. Those 3 things are the majority of the annotations that I use on the StockCharts platform. If you forget everything I just told you or trying to remember how to do it on your own computer, click on this little question mark. This is the chart notes help, and this will show you all the little tips and tricks, all the little keyboard shortcuts to use our annotations engine. That is your Power Up segment. And let's continue on with the Final Bar mailbag. As a reminder, the mailbag's always open. The Final Bar at StockCharts.com is the way to get your questions to us. And let's go to question number 1. Dave, does the Bullish Percent Index chart for sectors work similar to the S&P 500's Bullish Percent charts? Can you use indicators like RSI for the Bullish Percent indexes? Great question, and thank you for sharing your chart. Again, when you're asking a question about a chart, if you click on permalink and send me that link, then I can bring up the live version of exactly what you're asking me about. So this was the chart that you sent me. Thank you so much. I'm taking a look at it, and I will share a couple observations. Number one, this is probably a chart you use for other things like stocks, where log scale is a really good idea. Because when you're looking at price data, log scale, what's actually called a semi-log scale, is really meaningful, because what that does is it has a consistent percent term or a percent distance on the vertical axis. So instead of $1 having an equal distance across the y-axis, 1% does, which means lower values have a bigger space because it's a bigger percent move. But if you're looking at a bullish percent index, which is actually quoted in percents already, you're kind of double percenting it. And that's why you have this weird kind of crazy look. So below your chart, I would deselect where it says log scale. That's going to make this look way more reasonable. Candle charts are also kind of rough to view the bullish percent indexes on, in my opinion, because it's pretty noisy. I don't know if it adds a lot to it. So I'd probably change that to a solid line. And all of a sudden, this is starting to look a little more normal, a little more realistic, a little more digestible, I would say. Your real question was, does it work the same way for the sectors? And I would say absolutely, right? So if you look at energy, think about when it's above 70%, below 30%. I think that could certainly be meaningful. You asked about indicators like RSI. Absolutely. And to be completely 100% honest with you, in Workflowy, which is a way you can store ideas, it's sort of my rainy day list of things to dig into. I am not lying when I tell you one of the bullet points on my rainy day, spend some time tinkering with a technical analysis list, which is pretty long and cavernous, to be honest with you. One of the items is go through the sector breadth indexes, particularly the bullish percent indexes, because I've spent some time with them and I have a series of charts, a chart list just to go through them, but I don't use it a ton. And it's something I'd love to explore a little bit more. And the reason is because some of the sectors are a little less populated, right? So consumer discretionary, technology has a lot of names in there. If you look at a sector like materials, there aren't as many names. So the bullish percent data is going to be a little more spotty, right? It's going to be a little more chunky. If you look at the bullish percent index on the S&P 500, it's very smooth because you have 500 stocks and there's a lot of movement in there. With energy, there are these big jumps because there aren't that many names in the energy sector in the S&P 500. So it creates some issues. So having said that, theoretically, could you do overbought and oversold conditions? 100% yes. Can I tell you I've spent years doing it and here's what I would take away from it? No, but it is literally on my list. That's one of the things I love about financial analysis and particularly technical analysis. I'm still learning after 22 years of doing this, and I will share some of the great results I come up with. If you come up with any great ideas looking at the sector bullish percent indexes, please let me know. I'd love to hear it. Next question. When you run RRG on currencies, why use $1 as a benchmark? And you sent this screenshot. I think this was either from my video with Julius Kemeter, might have been from Julius's show. He has a show called Sector Spotlight where he often features different RRG methods that I think are really, really good. And I've been able to have Julius on my show a couple times here in the last month, which has been fantastic. He is a really knowledgeable, thoughtful strategist and analyst, and I look forward to bringing his insights to you more often. But what are we doing here? So this is looking at major currency pairs, and it's really spot currency. So you're looking at euro, dollar, British pound, dollar, Swedish krona, dollar, Japanese yen, dollar. That's what all of these represent. And you're doing them all versus the US dollar in the same way so that rotating them around the benchmarks makes sense. The problem is this: the relative rotation graph, the RRG, is designed to be relative to the thing in the crosshair. So when you're looking at the 11 S&P sectors, you put the S&P in the middle. Or if you're looking at a bunch of consumer staples stocks, you put the consumer staples ETF as the benchmark. And then you're looking at how all these things are performing relative to that benchmark, right? Here's my benchmark, consumer staples, or the S&P, or the Russell, and how are these members of that index doing relative to the benchmark? When you're looking at currencies, though, the question is, what do you put as the benchmark? You can't really put the dollar as a benchmark because all of these are already relative to the dollar just because the way that currencies are quoted. They're quoted in terms of the relationship between the two, between the currency pairs, basically. So $1 literally just makes this a 1. It puts it as a neutral benchmark. So you're literally looking at how they're rotating around each other, essentially, right? It's not a zero-sum game. You're literally looking at how the benchmarks are rotating around one another. And that's why you would do this for currencies. Does it make sense to do this for other things? Honestly, in practice, you could, but I found not a lot. If I was looking at cryptocurrencies, if I was looking at a bunch of currency pairs, doing it relative to $1 as a benchmark, I think makes a ton of sense. For most other things, you want to use some sort of either balanced benchmark like a mutual fund or index or something like the S&P 500, and that's the best benchmarks to use there. Experiment, though, and see which things you prefer. Final question. How can we see the investor sentiment indicator that Javed Mirza referred to in this week's show? Really good question. I don't have that chart in front of me, but I have a guess of exactly what chart you're talking about. So Javed actually had an indicator at the bottom of one of his charts, and he just called it investor sentiment. I actually asked him before the show what that was, and it was literally this series that I have at the bottom of my chart. Now, he did it a little differently, but this is the AAII chart that I often refer to. We usually use it on Thursday's show. And I use this indicator called price up-down pair, and I use the ticker for the bullish sentiment and the bearish sentiment. That gives you the green and red histogram like you see here. What he was doing was actually doing this spread, bulls minus bears. So you saw on the weekly chart, we'd gotten down to negative 40. That's because bears outnumbered bulls by about 40%. So he was doing weekly data or monthly data, if I remember right, and he was using this chart. He wasn't doing it as a histogram, though, which I was doing. I think he was just doing it as a solid line, which made it kind of look like this. So if you would use these tickers and make it as a line and do it on a weekly or monthly chart, should match up pretty well with what Javed Mirza from Canaccord Genuity shared earlier this week. Great questions, you guys all, and thank you so much for sharing your questions with us. Keep them coming, but we need to wrap the show and wrap this week. Let's go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're looking at the S&P Bullish Percent Index. All 3 of these, I think, are charts that I've shared in the last couple of weeks, but as I was going through the charts, preparing to write a note for my Market Misbehavior Premium members, it just came to mind that I thought these would be 3 charts to finish the week pretty well with. So if you look, the Bullish Percent Index gave a bit of a head fake over the holiday week, right? Last week was the shortened week for the Thanksgiving holiday, so shortened session on Wednesday, light session on Friday. We pulled back to right around 70%, and I highlighted that as a bearish sign, right? Because the last 3 times we'd gone above 70% and went below it. Those were great sell signals in August, in April, and in January. We didn't really complete that signal, right? We never really followed through below 70%, went below it one day, and then right back above there. And today we actually finished the week going higher, right? It's actually increasing as more and more members of the S&P 500 are seeing bullish point and figure charts. This is a great chart to watch. I was talking with Grayson Rose here at StockCharts earlier today. We were talking about the overall market environment, skepticism about further upside above 4,100, but this is a great chart to track that. And if and when we get below 70%, it's certainly more when than if. At some point, we go below 70%. I think that would be a good sell signal for stocks. Chart number 2 is the dollar index. I was interviewed earlier today from Market Watch, and I was talking with the reporter there about some of the different themes going into next year. And the weaker dollar in the last 6 to 8 weeks has been a key change, right? Stronger dollar has been the story from mid-2021 through most of 2022. That has changed dramatically. This week, we've actually broken below a key support level. The dollar index below 105 takes it below Fibonacci support and below the 200-day moving average for the first time since June of last year. That is a big breakdown. The momentum characteristics are overall very bearish. I see a weaker dollar continuing until this chart starts to change. Weaker dollar usually means non-U.S. markets start to look way more attractive. And I think this could be an interesting time to look outside the U.S. And we'll finish with one of those charts. If you asked me going into the last couple of weeks, best international chart out there, India would probably be my very first answer. And then I'd share other things like Brazil and other things that just haven't broken down as much, or maybe things like Japan that are starting to break above trendline resistance, which the S&P has not quite done. On the top half of this chart, we have the INDA, which is a dollar-denominated ETF, and the bottom, the India ET or the India index in local terms. It's made new 52-week highs this week. In dollar terms, it's actually starting to look constructive as well. We get very close or just a little bit above current levels. That is a head and shoulders continuation buy signal. Folks, that is a wrap for this week. Thank you so much for joining us. All of our previous episodes are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.